Hello, everyone. Welcome to today's webinar session, the Learn How Active Security Traders File 2014 Tax Returns for Maximum Tax Benefits. This is presented by Robert Green CPA from GreenTraderTax. Robert Green is a leading authority on trader tax. He's also a contributor to Forbes and Benzinga. He's done webinars for Lightspeed in the past, very informative regarding many different aspects of tax and tax reporting. So we are very lucky to have him present today for us and give us a lot of information that should be very helpful. So I want to introduce Robert here and have him take it away.
Thank you, Rob Lifson from Lightspeed Trading. We do work with many Lightspeed traders who are very active in securities markets, and they fall into the sweet spot of a lot of our tax breaks. So welcome today. We also have a lot of GreenTraderTax clients on the webinar as well. This is a GreenTraderTax event sponsored by Lightspeed Trading. So we're going to cover trader tax status, wash sales, Section 475 mark-to-market accounting, tax treatment, entities, and retirement plans. Just what an active trader is interested in. So let's go through the slides here. This is a photo of me. You also see a video there. I guess my hair is a little grayer now. So thank you for the introduction, Rob. I wrote the tax guide for traders. I write our annual trader tax guide. The 2015 guide is out. It's excellent. I wrote the Business of Trading column for Active Trader magazine for 14 years. Unfortunately, they just shut down the magazine. You'll see me and our other partners in the New York Times, Wall Street Journal, Forbes, Barron's. A couple of weeks ago, Teresa Carey of Barron's said she was a big fan of ours and really recommended that active traders use our software and our guide, that being the trade log software. We don't own it, but we add the tax knowledge to it. That's to calculate the wash sales and more. And you'll see me at the Traders Expo in just a couple of weeks in New York City. I give the tax session and I teach trader tax to CPAs as well. This is educational. This is not one-on-one tax advice. We encourage you to contact us or your other tax professional for advice. Make sure you deal with someone who's an expert in the area you deal with. If you bring up trader tax status and Section 475 to your local storefront accounting firm or accountant or H&R Block or whoever, you'll probably get a stare back from them like a deer caught in headlights. They just don't know this content. There's a lot of benefits at stake and a lot of pitfalls. And we're going to cover both of those today. And you'll see how you need to deal with an expert. Now, thank you, Lightspeed, and thank you to your traders for coming here. Lightspeed Trading is not responsible for this content. They don't give tax advice. And thank you, Rob Lifson, for the introduction. So here's the agenda. Trader tax status, wash sales, 475, tax treatment entities, employee benefit plans. These are just the very short agenda slides. We're going to learn how to save thousands by claiming trader tax status, business expense treatment, and you can do that on your 2014 tax returns. While no election was required, you do need to qualify for trader tax status, and you'll learn our golden rules for qualification. So after today's session, you may realize, hey, I can claim business expense treatment. My seminars, my home office, education, every tools, computers, the works, that will save you over $5,000. You didn't have to file an election. There are plenty of other things that you need to have filed a timely election for. This is not one. Now we're going to learn about wash sale losses. They're onerous rules. If you trade stocks and stock options, which many of you Lightspeed traders do, and or have multiple brokerage accounts. You have a Lightspeed account. You have an account with another broker. Your spouse has an account. You have an IRA account. You can't rely on the brokerage firm 1099-B, which is coming out soon, for reporting wash sales. Yes, brokers report wash sales, but differently from how you taxpayers need to report it. And we're going to cover that. We're going to talk about Section 475, mark-to-market accounting. I call it tax loss insurance. If your trading house burns down, you lose $50,000. You can write off the whole thing. You're not stuck with the capital loss limitation, and you're exempt from those onerous wash sale loss rules because it's true economic reporting at year end on it with unrealized and realized gains and losses. Now, you need to make a timely 475 election. And if you didn't elect that for 2014 by April 15th, you're out of luck. You're going to be stuck with a capital loss limitation and a large capital loss carryover. You're going to be stuck with wash sale losses at year end. There's nothing you can do after the fact. Now, this is predicated on having trader tax status, and that you can claim, but it's sort of like undergraduate school trader tax status and graduate school 475. They're related but different. We'll talk about tax treatment. Makes a world of difference. Is it a capital gain, a capital loss with a limitation, or is it ordinary? Ordinary losses are good. Ordinary income is the highest tax rates. Most financial instruments, including securities, Section 1256 contracts, those are your futures and E-minis, options, ETFs, indices, and Bitcoin held as a capital asset are subject to capital gains treatment. Now, by default, Forex contracts, swap contracts, Nadex binary options are subject to ordinary gain or loss treatment. So sometimes you want a capital gain, that lower rate with 1256 contracts, the 60-40 rates. That's great. But other times you like those ordinary losses because you can offset other income. So it goes every different which way. Now, lastly, we're going to get into entities and employee benefit plans. You're going to learn the added benefits of trading in an entity. If you have trader tax status, you should be trading in an entity. To unlock employee benefit plans like health insurance deductions, Obamacare, and retirement plans, you can save thousands of dollars more with those deductions. So trader tax status comes up first here. It constitutes business treatment. It unlocks an assortment of meaningful tax benefits for those who qualify. So a bunch of benefits. One, business expenses. They're far better than investment expenses. Two, we're going to cover how to qualify. Three, it gives you the opportunity to elect that tax loss insurance of 475. And four, it gives you the ability to do the employee benefit plans. The investment company, the investor without trader tax status, can't do the retirement plans and the health insurance premiums. They can't create compensation and earned income needed for that. Now, this is why business expense treatment is really good. Investment expense treatment is the default method for investors. But if you qualify for trader tax status, you can use a more favorable business expense treatment. You may have both things going on at once. On your Lightspeed account, you may have some margin interest, that's business interest, business expenses. But if you also have an online brokerage account with your spouse where you make buy and hold investments with margin, that's still investment interest expense. You can have both things happening at once. Now, business expense treatment under Section 162 gives full ordinary deductions, including home office, education, Section 195 startup expenses. Let me stop there for a second. Those three deductions are not allowed for investors. And those are very big deductions for business traders. Margin interest as a business expense is a lot better than investment interest, which is limited to investment income as an itemized deduction. Section 179, 100% depreciation, all your computers, your equipment, your desk, the works, your intangible assets, amortization on software. You want to write off your seminars in full, market data, and much more. Now, how do you qualify for this? That's the million-dollar question. Believe me, it could be a million-dollar question. If you have 475 tax loss insurance hanging in the balance, and you lose a lot of money trading and you want ordinary loss treatment, it all comes down to qualification for trader tax status. And that's what the IRS would want to attack. Now, here's the thing. There's no statutory law with objective tests. It's not written in the regulations exactly what qualifies and what doesn't. Rather, subjective case law applies. Now, taxpayers' trading activity must be substantial, regular, frequent, and continuous. That's in the case law. But where are the numbers? It doesn't say 1,000 trades, 500 trades. It doesn't give you any numbers. These terms can be misconstrued and taken out of context, and everybody's situation is different. Now, the second pillar is the taxpayer must seek to catch the swings in the daily market movements. That does not mean day trading necessarily, but you're looking for daily market movements and to profit from these short-term changes rather than profiting from long-term investing. Now, here are the golden rules that we've crafted and continue to update as required from year to year based on our experience working in this area where we are really, I guess, have a significant practice dealing with thousands of traders for for several decades. And these rules came out in 1997 with mark-to-market and trader tax status. And we look at the trader tax court cases every year and we analyze them on our site and in our guides. So these are our golden rules. Substantial volume makes close to 1,000 individual trades per year on an annualized basis. That means if you start July 1st, it's 500. It's annualized. If you start in Q4, it's 250. If you start in November, late November, maybe it's too narrow a window of opportunity to claim the status. Now, count trade confirmations and separate legs of complex options trades. You cannot count expirations of options or unexecuted trades. So if you have a big trade that you put in and it's broken down, you can probably count each of the lots. We want to see substantial proceeds. That's millions if it's securities, less for options, futures, and Forex. Should be regular trades full-time or part-time for a good part of the day, almost every day. Frequent, this is a big one. Executes trades on more than 75% of available trading days. That's close to 4 days a week. That's not 2 days a week. Those are the cases where they fail. 3, you might get away with it, but we want you closer to 4. The cases that failed were 2 days a week. Substantial volume we did that one already. Continuous, has few to no sporadic lapses in the trading business during the year. 1 month on, 1 month off is not acceptable. Time, spends more than 4 hours per day, almost every market day, working on the trading business. Daily market movements makes mostly day trades or swing trades with average holding periods under a few weeks on equities and no more than 30 days on options. So if you're just trading options, you may have problems here. But if you trade the weeklies, you could be okay. It's harder for an options trader to qualify. Now, you can qualify as a part-time trader, but the IRS is going to really make sure that you hit these golden rules. They raise the bar. Now, you need to have the intention to run a business to make a living. It doesn't have to be a primary living, and you can have perennial losses as the hobby loss rules don't apply to a trading business. Business setup, you have to have significant business equipment, computers, monitors, education, business expenses, and a home office. Don't shy off taking your home office deduction. A lot of traders have multiple monitors, computers, mobile devices. It's pretty elaborate setups, and they easily hit the 4 hours a day unless they're automated trading. So I would say that the problem areas are volume of trades, getting that 1,000 number, and getting the frequency at 75%. I think regular continuous time, the daily market movements, intention, the setup, materiality, people usually are pretty good there. Now, it's got to be a material account size. You need 25,000 to be a patent day trader. which light speed traders probably are. And some people have gone into options, Forex, and futures because you can have lower account sizes, and then it may not be material enough for trader tax status. Excuse me, I'm jumping around here. Hold on. Now, what doesn't qualify? Automated trading without much involvement by the trader doesn't qualify. But if you create your own program, it qualifies. If you engage a professional investment manager, you're not making the trades, the manager is. When you trade in retirement funds, that's not taxable account trading. That does not count. So if you say I have 1,000 trades, 400 in my IRA and 600 in my taxable account, then you don't hit the golden rules. You can't count the retirement funds. A lot of people get automated trading help for signals, entry, exit points, but they manually execute the trades themselves, or they make a lot of the trading decisions and they use automation to help with the execution. The key thing is you have to be in the cockpit flying the plane manually and with automated help, which pilots do. You can't be sitting as a passenger with a pilot flying for you. Otherwise, you don't get credit for it. Now, remember, the last benefit is the employee benefit plans. You can unlock and get all those benefits. We'll cover those soon. An investment company can't do it. So that's trader tax status. So we're going to talk about wash sale losses. Active securities traders focusing on a few symbols generate many wash sale loss deferrals, which can cause headaches and extra tax liability. Now, I know that a lot of active traders, they pick out a few symbols that they focus on, that they know the headline risk, they know these charts inside out. They're not looking to trade 50 symbols, they're trading a handful. Now, here's the thing, and I assume everybody can see my screen okay. Maybe on the question you can put in if you don't see the screen, but I assume that you do. Okay. Now, what's it all about when I talk about wash sale losses? It's about tax losses versus economic losses. The IRS wash sale loss rules, Section 1091, are written to protect the U.S. Treasury against taxpayers taking tax losses at year end. You know, you hear that every year. Hey, sell your losing positions, get a tax loss, reduce your capital gains, reduce your tax bill. And then people get right back into those same positions. So the IRS views that as a tax loss, but not an economic loss. And much of the tax code prevents that from happening. The straddle rules, the short against the box rules, the offsetting position rules. The IRS is very focused on not having people game the system. Now, these rules are such a headache. They're a lot more trouble than they're worth to the IRS or to you. And that's really going to be apparent again this year. So here's the thing. Section 1091 wash sale loss rules. According to publication 550, a wash sale occurs when you sell or trade stock or securities at a loss and within 30 days before or after the sale, this is cutting and pasting from 550, you buy a substantially identical stock or securities, you acquire substantially identical stock or securities in a fully taxable account trade, you acquire a contract or option to buy substantially identical stock or securities, or acquire substantially identical stock for your individual IRA or Roth IRA. I would have written this differently. Bottom line is this. If you trade Apple as an individual, you have an individual account and you trade Apple and you buy back Apple options within the 30 days, that's a wash sale because that's substantially identical. If you buy back Apple stock or Apple options in your IRA, it's a wash sale. If you buy it back in your spouse's account, in your joint account, every account connected to your individual account, including IRAs and Roth IRAs, That's the wash sale rule. Okay. Hopefully your broker is going to help, right? That's what you would expect. Now, Lightspeed, relies on the clearing broker, and the clearing broker, what do brokers do? Brokers follow their set of rules. They have very specific rules from the IRS on how to calculate wash sales. And their job is to follow those rules. Well, guess what? The IRS rules for brokers are different from the rules for taxpayers. That's crazy. Brokers calculate wash sales based on identical positions, an exact symbol only, per the separate brokerage account. But Section 1091 requires taxpayers to calculate wash sales based on substantially identical positions. Not identical, substantially. So the broker only does it based on Apple stock, and you need to do it on Apple stock and Apple options. And options at different strike dates. And across all your accounts, including the IRAs and Roth IRAs. Even if your broker ever did it based on substantially identical positions, and even if they did it across all their accounts that you have with them, they would never do it with another broker that you have accounts with. You're always going to have a disconnect. Now, this year, it's going to seem like a big disconnect because options are reported for the first time on 1099-Bs. So if you trade Apple stock and Apple options, your broker's not going to show a wash sale, but you have a wash sale, and you may have it with other accounts. So there's a big mess this year. Let's go to the next screen. So you need software to calculate wash sales across all accounts. If you actively trade equities and equity options, a lot of you Lightspeed traders do, and or securities in more than one account, unless you use proper software on all your individual taxable and IRA accounts, you will probably handle wash sales wrong and underreport or overreport your taxable income. Don't assume that doing it right, the way we're telling you to do it, is going to be worse for you. It may not be. It may be that you have a loss, a wash sale loss problem with Apple stock, but a gain that you had in Apple options could have absorbed it and made the wash sale disappear. That's what happens. Subsequent gains absorb the wash sales. What's this all about? You just don't want phantom income at year end. You don't want to say, hey, Bob, I made $50,000, and then have us tell you, no, you have to report $100,000. You have $50,000 of year end wash sale problems. You don't want that. So you need the software. Now, if you only have one account, your Lightspeed account, you have no other accounts, or you have one account in an entity name that's not connected to your IRAs and your other individual accounts. So that gets rid of the problem of across all accounts. And if you just trade securities, you don't trade options, then you probably could rely on the 1099 because it's one account and it's just the securities. Now, we have a whole blog on this, and we have a webinar coming up on February 25th just about this issue. We're going to show you 1099s. We're going to deal with all these issues. So in most cases, you can't rely on the 1099-B reporting because brokers use a different set of rules. All right. One way to get out of wash sales going forward is to elect 475. It exempts active securities traders, business traders, from wash sale losses and capital loss limitations. So Section 475, mark-to-market accounting, allows business traders to deduct trading losses in the current tax year, avoiding capital loss limitations and wash sale loss treatment, two big problems for securities traders. When traders have negative taxable income generated from business losses, Section 475 accounting classifies them as unrestricted, unlimited, ordinary business losses and net operating losses. So you're single, you file single. You're a full-time Lightspeed trader. as an individual and you elected 475 for 2014 by April 15th, 2014, and you had a bad year. Hopefully you had a good year, but let's say you had a bad year. And that's what happens to traders. They have some good years, they have some bad years. You want full deductions in those bad years. You want to carry back the losses to the good years and get money back to replenish your trading account. That's the name of the game. So with 475, let's say you have a $100,000 loss, your other income is $20,000, so you have minus 80. Well, most of that minus 80 will be a net operating loss that you can carry back 2 years against income of any kind, trading or not, to get a huge refund and interest. It's a very powerful deduction. We call it tax loss insurance. If you're sitting here today with big losses year to date in the markets, they've been choppy markets. If you've lost $25,000 in securities year to date, and you've never elected 475 before, you want to file a 475 election by April 15th of this year, the due date, and then maybe get into an entity for a do-over if you have some capital loss carryovers to use up. We'll go through all those iterations, and I walk you through all that decision making in Green's 2015 Trader Tax Guide. So, existing taxpayers elect 475 by April 15, 2015 for a 015 election. That's the current year. If you're trading as an S Corp, it's by March 15th. And you send an election statement to the IRS. So you attach it to your extension. So when you file your 2014 extension as an individual, by April 15th, you're going to attach this election statement to it. We give you the statement in the guide. Now, if you set up a new entity, and that's a big business for us, we set up your S Corp, your single member LLC with an S Corp election, or your multi-member LLC with S Corp election. We set up your trading entity, or you're filing a partnership return and you have a C Corp management company, or you have no management company. We'll go through entities later. That new entity is a new taxpayer. It elects 475 within 75 days of inception by an internal resolution in your own books and records. So let's say you make the election individually by April 15th and then form an entity afterwards. You would then have 75 days from the formation of that entity to elect again. This is very important when it comes to climbing out of a capital loss carryover hole, because you need capital gains to soak up capital loss carryovers. And the entity is the do-over. So there are many nuances and some gambles with the election if you have the capital loss carryover. It's way beyond the scope of today's webinar, but I walk you through all of that in Chapter 2 of Green's 2015 Trader Tax Guide. That's a must-read. Tax treatment. Which financial products you trade and where you trade them can make a huge difference in tax savings. So we're going to talk, look at the various instruments and delve into how they're taxed. I know most of you are trading securities. So you got to watch out for the higher tax rates, the ordinary rates on short-term capital gains, the wash sales, the capital loss limitations, the accounting challenges. Now, securities include equities. Those are your stocks, equity options, your stock options, narrow-based indices or indexes, where they're made up of 9 or fewer securities. Most indexes are broad-based. They're 1256, but there are some narrow-based ones. ETFs are securities. Options on ETFs, if they're regulated investment corps, are securities. So when you sell an ETF, even a commodities ETF, you're selling a security. Bonds, mutual funds, single stock futures. Now, 1256 contracts enjoy lower 60/40 tax rates, summary reporting, and no need for accounting. They include U.S. futures, regulated futures contracts, and options on futures. Foreign futures only if they have the IRS approval. Broad-based indices, those are all the E-minis, the NASDAQ 100, 500, because it's made up of 10 or more securities. Forex forwards if you make an opt-out election, options on commodities, ETFs if they're publicly traded partnerships, and other non-equity options. So when you sell an ETF, you're selling a security. If it's a precious metals ETF, that's a publicly traded trust, and so it's treated as if you're selling precious metals, and the collectibles rate applies. And it currently goes up to 28%. It's not necessarily 28%. It goes up to 28%. So options cover the gamut. A lot of you probably trade equity options, and those are securities. So the equity options include stock options, options on narrow-based indices, and options on securities ETFs. The non-equity options are the options on futures, the broad-based indices, and the commodity ETFs. Forex is a whole other world. We just did a big Forex session yesterday, and that's going up on YouTube, so you can get that recording. Go on our website. That was an excellent session. We did that yesterday. Bitcoin is intangible asset. Nadex is ordinary. Swaps ordinary. So we covered deposit losses on yesterday's session as well. Now let's get into some really good stuff. That one of the real important agenda items for today was, how do you file that 014 tax return? What do? Your 1099s are coming out soon. You're going to deal with your wash sale issues. Probably consider the software solution we talked about. Get your numbers together. But then how do you report trader tax status? Where do you put all your trades, securities versus 1256? So the IRS hasn't created specialized tax forms for individual trading businesses. Traders enter gains and losses, portfolio income, business expenses, and investment expenses on various forms, on various lines. It's not all in one spot. So the first thing to tackle is that Form 8949, where you report your line-by-line securities trades. You can't just say details available on request. Now, in one simple case where you have no wash sales, no adjustments, one brokerage account, you might be able to just attach the 1099B, but that's someone who's not an active trader. But everyone else is going to have to fill out this Form 8949 and make all the wash sale adjustments, the cost basis adjustments, and more. And it can get very confusing. So you report securities trades. It's a big challenge on Form 8949. You deal with the IRS cost basis reporting rules, including the wash sale loss adjustments. The cost basis rules are almost fully phased in. The options and less complex fixed income securities acquired on January 1st, 2014 or later are reportable for the first time on Form 1099Bs for 2014. You never saw that before. They always put like totals for options as supplemental information behind the 1099B. This time it's going to be in the line-by-line reporting. The last item of cost basis, the complex debt instruments, that was delayed until 2016. All right, so you got your Form 8949 together. I suggest you use the software for that, and it just generates the Form 8949. You run it on all your accounts, you press the button, you reconcile the 1099Bs, you check with us about it. We have an accounting service. We can do that for you. You don't even have to buy the software license. We can do it, and there's no license fee. I'm talking about TradeLog now. So that's one area of the tax compliance. That's the big issue that can run up cost on you. You want to be on top of your Form 8949 because we look at that as like a separate cost center versus our preparation of the tax forms. And we have form pricing. So you can look at the tax. We have the price list right on our website. You can see what it's going to cost, whether rental properties, K1, Schedule B. You can figure it out. And it's very reasonable. Now, what are you going to do with trader tax status? Sole proprietor Schedule C. You just add it to your tax return. You just fill it out. That's where you put your business expenses. Now, without any revenue in a trading business, there is no revenue on Schedule C. Don't let a local accountant who is misinformed on these issues, don't let them say, oh, okay, let's put all your trading gains and losses on Schedule C. That we've seen a lot of CPAs and tax preparers, enrolled agents do that. Automatic audit. Automatic triggers IRS computers. The IRS is looking for the Form 8949 or the Form 4797 if you have mark-to-market accounting. And they're looking for numbers that resemble what's on the 1099-B. They're not going to look for what you have a revenue on Schedule C. That's for other businesses like an accounting business or a law firm or an architect or a computer consultant or a real estate agent. They have revenue. You don't. So the Schedule C shows a net loss, shows a minus $25,000. That's a red flag. It's going to flip out the IRS computers. You'll probably get a notice. So to nip that in the bud and not get a notice, you need to include a tax return footnote explaining trader tax status and why your business may be profitable, if in fact you are profitable, after factoring in trading gains reported on the other tax forms. Now, we explain how to do a transfer of income strategy to zero out Schedule C. We transfer from Form 8949, $25,000 of business trading gains to Schedule C on the other income line, which unlocks the home office deduction and the 179 100% depreciation, and then comes to zero. Very important strategy. The front of the return doesn't even show a Schedule C. It doesn't. The IRS computers stay asleep on it. Read about that in the guide. It's a must read. If you're going to use trader tax status, you simply must have the guide and probably consider our services. So your trading gains and losses are reported on other tax forms, depending on the situation. Form 8949 for securities if you're using the cash method. Form 4797, Part 2, ordinary gain or loss if you're using Section 475 MTM. Form 6781 for your Section 1256 contracts, summary reporting. Or line 21 at 1040 for Section 988 Forex. Your home office expenses are first reportable on Form 8829. And you can point that schedule to your trading gains to unlock them rather than move them over to Schedule C. Depreciation and amortization is reported on Form 4562, and it needs to have income for 100% Section 179 depreciation, which is the most beneficial. Otherwise, you're writing it off over a few years, accelerated. It can also look to wages of you or your spouse. It doesn't have to just be business income from the trading. Now, entity tax returns, they're much better. All the trading gains, losses, and expenses are consolidated on the entity tax return. You don't have to look all over the map with expenses on Schedule C, some gains here, some losses here. It's all on that Form 1065 for a partnership or the Form 1120S for the S Corp. And if you have mark-to-market accounting, it may show a nice net income number. It shows the gains, it shows the expenses, it shows the net income. And then it passes over to your individual return in a nice, clean way. The entity return is so much better. Now remember, we advocate pass-through entities, S Corps or partnerships, and they're tax filers, but they're not taxpayers. They pass the summarized income or loss to the individual return, retaining the character of what's interest, what's dividends, what's short-term capital gains, what's 475, what's 60/40, and business expenses. So, entity solutions. It can save you a lot more taxes, not just look better on trader tax status and keep the IRS off your back, but it can save you a lot of money. Now, we talked about before with the wash sales. it can divorce it from the IRA. So with a pass-through entity, business traders solidify trader tax status. It looks a lot better. They don't see you also have a job, that you've always been a doctor or an opera singer or a computer consultant. Traders cover the gamut. The entity unlocks employee benefit plan deductions, the retirement plan, the health insurance. The sole proprietor trader can't get those deductions. And it gives you much better flexibility for the 475 election. If you elected it late in the year, you can make an election after April 15th with the entity. And it's so much better to elect it in the entity, because if you want to get out of 475, you just close the entity. As an individual, it hangs on your back as long as you qualify for trader tax status. And we cover all that in the guide. So the entity is better. And even if you don't have trader tax status, an entity can make sense if you do extensive trading in your other individual accounts and IRAs, because the entity is a different taxpayer. It's divorced from the IRA for wash sales. Just one second. Okay. Now, the sole proprietor can't have the employee benefit plan deductions. That's worth thousands of dollars. The entity is simple and inexpensive to set up. Check out our entity formation service. There's a lot more information about it in the guide and on our site. We recommend the pass-through entity. That's the best thing for your needs. You're not going to trade in a C Corp. There's double taxation. And if you don't have trader tax status, a C Corp doesn't help, because you can't deduct only investment expenses in a C Corp. You need to have business treatment in a C Corp. So between double taxation, no 60/40, and no deductions if you're an investor, forget the C Corp. You're dealing with a pass-through entity. We like the S Corp. There's no such thing as forming an S Corp. You form either a C Corp or an LLC and elect S Corp status. In all but 6 states, a general partnership can elect S Corp status. The S Corp pays compensation, officer's salary, to the owner. That efficiently unlocks health insurance premium and retirement plan contribution deductions. So you add the health insurance to your wages on the W-2, and then you get the deduction on your individual return. And then the profit sharing plan deduction is on the entity. The 25% employer profit sharing plan is there. And the elective deferral, $18,000 for this year, is deducted from your W-2. We show you all the math on how that works in the guide. How to deduct those huge amounts, and I'm going to show you in a second what those numbers are. So you can form a single member LLC or a multi-member spousal LLC, and the LLC can elect S Corp tax treatment within 75 days of inception or by March 15th of the following year. So if we form an LLC this week, next week, we would file that election within 75 days. If you had a partnership from the past and you want that election, you need to make that election by this March 15th. Don't miss the March 15th S Corp election. Now, the biggest benefit of the trading entity is the retirement plan deduction. Now, traders get involved with their retirement plans. They can trade in the retirement plan. They can build it up with annual tax-deductible contributions. They can borrow money from it to start a trading business, and they can convert it to a Roth IRA for permanent tax-free buildup. There's a lot of things to consider with retirement plans. Now, the big thing that we've been talking about today is the retirement plan contribution. Our clients from last year that had an S Corp, they did wages before year end, and they maximized these deductions. So, because a retirement plan contribution requires self-employment income or wages. Trading gains or portfolio income are not self-employment income. It's not compensation. So you can't do it. You can overcome this obstacle with a trading business entity which pays compensation to the owner trader. When the S Corp pays you compensation, that fills up the bucket. When a partnership pays you an administration fee, it fills up the bucket, but then you have to pick up your share of the partnership loss, which drains the bucket. You can never get there with the partnership. But with the S Corp, you just pay the wages and you're there. The best retirement plans for traders are employer 401k plans, and if you make a lot of money, defined benefit plans. The employer 401k plan combines a 100% deductible elective deferral contribution at $17,500 for 2014, $18,000 for 2015, plus a 25% deductible profit sharing plan. There is also a catch-up provision, $5,500 for 2014 and $6,000 for 2015 for taxpayers age 50 and over. Excuse me. Now, together, the maximum tax-deductible contribution is $52,000 per year and $57,500 including the catch-up provision. This is based on the 2014 limits. The 2015 limits are 53 and 59. Think about it. You're going to get an income tax deduction for $59,000. You might be saving taxes at 40%, federal and state. Yes, you have payroll taxes. The FICA is on the Social Security base of $118,000, the 15.3%, and you pay the 2.9% Medicare thereafter. But that's a drop in the bucket compared to the 40% times the $59,000. You want to see the math? It's in the guide. We give you an exact example on how to maximize it, showing you all the numbers of the savings. Now, with an employer 401k plan, it's a qualified plan. You can borrow up to $50,000 or 50% of plan assets, the lower of. And you can use that money to finance a trading business. So you can take your IRA, roll it over into a employer 401k, set up your S Corp, borrow $50,000 to fund the taxable part of your S Corp. That's the way you do it in a smart way. There's a lot of do's and don'ts. We walk you through that through the guide. Consider a Roth conversion when you want to soak up losses as well, or in a year where you're not paying many taxes. There's a lot of do's and don'ts. You do not want to get excise tax penalties, early withdrawals. You don't want prohibited transactions. You don't want IRA-owned LLCs. I don't want to go too much into this. Read about it on our site. Now, let's get to some of your questions and some of the polls.